Hello, my name is Austin Frazier, and we'd like to welcome you to our fourth quarter 2025 market outlook. Some of you joining us may be our clients, and others are not. Whatever the case may be, we hope you see value in the market viewpoints from our advisors here at Capital Strategies Group. As certified financial planner practitioners, we take an unbiased and fiduciary approach to the way that we help our clients. We are constantly keeping an eye on market movements and staying updated through various resources. We'd love to share our insights with you, but it's important to note that just because we're discussing these topics doesn't necessarily mean that adjustments are warranted in your portfolio. News headlines can sometimes create a sense of urgency to take action, but it's important to recognize that not every situation necessitates immediate action or intervention. As Q3 has now come to a close, it's clear that several things stood out. The markets were noisy, headlines were loud, and 2025 has certainly been full of surprises. But beyond all those distractions, the core message shines through. Consumers are holding strong. Businesses are evolving, and there's solid ground for optimism in the years ahead. My aim in this video is to help you filter out the distractions and help keep you anchored to the broader view as we enter the year's home stretch. First, let's kick things off by talking about the state of the consumer. Believe it or not, consumer wealth is at record levels. Despite the constant drumbeat of negative headlines, the financial health of households paints a brighter picture as we head into the final chapter of the year. In Q2, net worth for households and nonprofits climbed by more than $7 trillion, hitting a peak of $176 trillion. Meanwhile, household debt has edged up only minimally. This has pushed household leverage, the debt-to-asset ratio, down to its lowest point in almost 6 decades. Bottom line, American families are in an exceptionally strong financial position. What's also worth mentioning is the recent relief we've seen come to mortgage rates. The outlook is a bit more positive for potential homebuyers. Leading into the Fed's expected rate reduction recently, mortgage rates fell to their lowest in 11 months. Hopes for additional Fed cuts could drive borrowing costs down further, easing affordability in the housing market. On the flip side, employment trends are softening. Unemployment has risen a touch, and job positions have dropped notably from their peaks. With fewer job openings, competition ramps up, potentially slowing wage growth, which isn't ideal for folks dealing with rising expenses. Shifting over to the state of companies, here's what's noteworthy. First, profits and margins continue to increase. As Goldman Sachs analyst David Kostin highlighted recently, a moderating job market can actually boost corporate earnings, assuming other factors hold steady. We're witnessing this unfold, even as corporate profits and margins were already climbing. While stagnant wages aren't great news overall for us as investors, it often translates to better operations and healthier profits in our portfolios. Now, let's talk about the investing landscape. First, the Fed's long-awaited rate cut finally happened. A modest 0.25% cut. The market still expects a couple more quarter-point reductions by year's end, with several additional cuts expected in the first part of 2026. Second, stock prices stay stretched on standard measures, and equities are pricey by historical standards. Yet, past examples show that doesn't guarantee weak returns. A decade ago, stocks seemed expensive, but the gains since then have been impressive. Businesses have shown greater durability and profitability than anticipated. With AI-driven efficiencies and tech breakthroughs continuing, the coming decade could surprise us positively again. The third point I'll make here is that patience has proven profitable, and 2025 reinforced that notion. The stock market dipped almost 18% from January to April, teetering on bear territory. Now, the stock market is up 14% for the year. Far more than a mere recovery. Those who held firm reaped the rewards once more. My fourth point is that there are positive signals even amid the buzz. Beyond the headlines, many economic signs are encouraging. Policy uncertainty is decreasing. Consumer sentiment is improving. Businesses are ramping up investments. Lending from banks is flowing. Bankruptcies are declining. and startup activity is at near 40-year highs. Inflation lingers as a worry, but the economy as a whole seems firmly grounded. In closing, Q3 was full of noise, but the underlying theme is evident. Resilience is prevailing. Consumers are financially robust. Companies are adjusting effectively, and patient investors have seen strong returns. Challenges persist, like sluggish hiring, high valuations, and ongoing inflation. But looking back, innovation, productivity, and human ingenuity have repeatedly driven markets upward. As we gear up for the last quarter of 2025, perspective is crucial. By staying disciplined and focusing on the long term, we give ourselves the best chance to capture the opportunities that lie ahead. We appreciate you taking the time to join us for this Q4 economic and market outlook. If you aren't currently a client of Capital Strategies Group and would benefit from having an expert at the helm helping you navigate this challenging market landscape, we invite you to reach out to us. Take care, and thank you for watching.